Buongiorno a tutti. Innanzitutto grazie mille di essere intervenuti alla nostra conferenza al Salone del Risparmio. Sono Lorenzo Alfieri, responsabile in Italia di J.P.Morgan Management. Quest'anno il Salone si occupa di investimenti, o meglio di lungo termine, del lungo termine, un tema a noi ovviamente molto caro. Abbiamo pensato di fare una cosa interessante quest'anno, di cercare un po' di guardare a questo argomento in un modo leggermente diverso, cioè di guardare agli investimenti dal punto di vista del cliente, cioè come attrarre, come focalizzare i vostri e i nostri clienti sul lungo termine. Per questo motivo abbiamo invitato Andrew Goldberg, che è responsabile in Europa del nostro team di Market Strategy, a sviluppare questo argomento. La presentazione sarà solo in inglese, quindi vi invito a utilizzare le cuffie. Solo una richiesta: quando uscirete lascerete le cuffie, se potete anche lasciare il feedback form che credo vi sia stato dato col raccoglitore. Quindi grazie ancora della vostra partecipazione e Andrew, your time.
Grazie Lorenzo. Lorenzo, grazie. Buongiorno. Come on, buongiorno. That's all I know. No, in truth, I actually speak fluent Italian, but my boss asked me to do some work on my English. So today I'm going to do the presentation in English, since I need some practice. What I want to talk today a little bit about is long-term investing. When times are difficult, all of our clients become nervous. It's hard for our clients to think about the world 10 years from now. I kind of think of it almost as if our clients were locked into a room with no lights. Imagine for a minute if you were in a room and you couldn't see anything. It can be scary. But if instead you can turn on the lights for just 1 minute and show them, over here is a chair, over here is the podium, over here are the stairs, and they then understand what's in the room around them, it's not as scary when the lights are off. That's what this is designed to do. It's designed to illuminate the room around our clients and help them better understand their investment environment. Now, I want to do that using our Guide to the Markets book. This is something that we publish in 26 countries and across 16 languages, Italian being one of them. And today I want to talk really about 3 key topics. The first thing is, I want to set the stage a little bit. I want to talk about some of the challenges that face your clients and mine as investors. And then from there, I'll show you 10 ways that we think you can leverage the material that J.P.Morgan produces to help your clients understand the world around them and to help them make better long-term decisions. And then finally, at the end, of course, the world isn't only about the long term. So I want to share with you just a little bit of our outlook for the rest of 2014, some of which you may have already heard from the very talented Paola Toschi, who is our strategist based right here in Milano. So first, let me set the stage and talk about some of the challenges that our clients all face. These statistics are based on 2 studies, one from HSBC and one from State Street. And what you can see from these studies is, basically, investors are not comfortable about their future. In fact, 64% of semi-retirees, people that are not completely done working, wish that they never stopped working full-time in the first place. They probably have less money than they wish they did. In fact, 63% of retirees worry that they won't have enough money in the end. Perhaps the more important statistics are at the bottom. 65%. Now this is really important for you, and this is really important for me. 65% of investors are not loyal to their primary investment advisor. That's a huge problem. And this really got worse since the financial crisis. So they're not loyal to me and they're not loyal to you. Not all of them. 1/3 of investors believe, and this is really important, that their primary investment provider is working for them in their best interest. Only 1/3. And this has all led to one major problem. And that's the problem that you see at the bottom, which is that people have become more and more focused on the short term, not the long term. People used to invest for a period of up to 6 years. Now their average holding period is 11 months. They're too short-term focused. That's the challenge. And what I want to do today is show you how I think we can help. But first, there are some obvious reasons why we need to be long-term investors. Everything ranging from retirement to leaving money behind for your family or for a gift to charity, whether it's recreation. We have lots of reasons to be long-term investors. But I want to prove to you that I care about this personally. This isn't just, J.P.Morgan didn't hire me to come and make a presentation about the long term. I actually believe in this. And so I want to give you some personal examples, some real life examples in my life for why long-term investing is so important. And first, these are my grandparents. My grandparents moved to the United States of America with nothing. They started investing early on when they were 17 years old so that their family could live a better life when they were gone. And it worked. They were successful. And it enabled my mom and dad to be in a better position. By the way, my parents do not know about this, okay? If you ever run into my mom and dad, do not tell them that this happened, okay? This is my parents on the left right here. Does anybody want to guess which year? 1974, okay? Don't ever tell them this. This is me right here, meeting my little brother for the first time. And my parents had to be long-term investors because we were very expensive children. I know it's not very popular in Italy, but ice hockey in America is pretty popular. Ice hockey, you need skates, shin pads, hockey pants, elbow protection, shoulder guards, helmet, hockey stick. Very expensive children. And now today, now that my parents are 65, my parents need to be thinking about their retirement. They too are long-term investors. Then, of course, there's my wife. Paola, how do you say wife in Italian? Say, moglie? Okay, I can't. That's my wife, okay? My wife is a long-term investor. She wants a bigger apartment in New York City. We'll see. And the other reason is my wife's sister just had a little baby. That's the baby right there. His name is actually, he comes from an Italian family. Angelo Russo, very good, okay? Now that there's a baby in the family, my wife wants one, okay? She's a long-term investor too. And finally, I'll just tell you a little bit about myself. Why am I a long-term investor? And this is something that's very close to my heart. In fact, this is something that I don't often talk about in public. It's very special to me, but I wanted to share it with you today to show you that I too am a long-term investor. Ultimately, the reason I'm a long-term investor is I love Italian cars, okay? Now, let me just say, I'll tell you in a minute. When I showed this presentation to my wife, she said, be careful. They're going to think that you're only showing Ferrari and Lamborghini, okay? Because I'm in Italy. Maybe in England, you show Aston Martin, Maybe in Germany I show Porsche. No, okay? I love Ferraris. One quick question for you. How many people believe me that I actually love Ferraris and am not just doing this? Okay, good. And just in case you don't, it's not, no Aston Martin, okay? No Porsche. This is me in 1988. That's a Lamborghini. 8 years old. What do you think? How about 2002? That's a Lamborghini Diablo. That was in New York City. I didn't know that guy, but he let me sit in there. 2007, now I was 27 years old. Here's this is a Lamborghini. 2009. This is me in 2012, only 2 years ago. That's my favorite. Oh, that's the Ferrari 458. You guys might know that. And then this is me only 2 months ago in Paris. For 89 euros, you can drive a Ferrari around Paris. Beautiful, okay? I am a long-term investor because after all this time, this has been going on for 30 years. How many Ferraris do you think I have? Let me put it this way. Do you think that I have a Ferrari yet? How many people think yes? How many people think no? Here's the answer. Okay? None. Not yet. How many people think I will have one? Yes, I will. But it takes time. That's why I'm a long-term investor. Now, I want to get into these 10 ways that I think you can talk to your clients about long-term investing. And the pictures that I'm going to show you all come from the J.P.Morgan Guide to the Markets book. And each of these 10 lessons is something that I've learned in working at J.P.Morgan over time. And each of these 10 lessons are something that I believe in. Also, we're more than happy to send you this presentation following the meeting today. If you go and visit the J.P.Morgan booth right outside, you can actually play with the new iPad app and get some of these materials. But let's get into this. This is lesson number 10. Most of our clients, and in fact, you and me, are probably going to live longer than we ever thought. This chart is page 70 from the Guide to the Markets. All the page numbers will be right up here on the top. And what you see on the left is the odds or the statistical probability of living to age 80 or living to age 90 if already today you're 65 years old. So as an example, if you are a married couple today, the odds that one of you will reach age 90 is almost 50%. In fact, when these 65-year-old people were born, their life expectancy originally was only 65. Now, there's a 50% chance that they're going to be 90 years old. This is the kind of chart that I think you need to show investors to help them understand. Even if they're retired, they might have 10, 20, 30 more years to live. And their money running out could be a problem. This study on the right-hand side is from HSBC. They canvassed or surveyed a number of different countries. Interestingly enough, they did not include Italy. I don't know why. But one thing that you can see is that most of these countries have less money than they will ultimately need to retire. We are going to live longer, and we are not going to have enough money. This is why your clients need you more than ever. To me, this chart is the best case for financial advice in the world. I use it in every client meeting. Now, let's move on. Let's talk about rule number 9, okay? When our clients are scared, what do they want to do? Put their money in their pocket. They want to put it in the bank. They want to keep cash because they think it's safe. Is cash really that safe? I mean, don't get me wrong. I like cash. If I had more cash, I could have a Ferrari, okay? I have a problem with too much cash and not enough investments. This is page 11 from the Guide to the Markets. On the left-hand side of the chart, you can see that during the recession, people put more and more of their money in the bank account. They thought it was safe. It's come down a little bit as confidence has come back. But the problem is, over on the right-hand side, you can see a very powerful message. The message is, if your client put 100,000 euros in the average bank account across all of Europe. Now, Italy's a little different. So this is the average for Europe. For one full year, in 2007, they would have earned interest income of around 4.7%. They would have earned income that year of 4,580 euros. That's not bad. You can use that money to go on vacation. You can use that money to make a car payment on, let's say, a Ferrari. Today, ever since Mario Draghi and the European Central Bank decided that they would lower interest rates, today, if you have 100,000 euros in the bank, the most you could earn on the average bank account is 400 euros. 400, not 4,000. Now, the key is, you all know this. This is not new to you. But our goal is to give you third-party, unbiased information that you can use to show your clients that sitting in cash is not as safe as they might think it is, okay? Now, one little thing I want to mention about the European Central Bank and about the Federal Reserve in the US and about the Bank of England. They started this new thing called forward guidance. There was a recession, and they lowered interest rates to revive the economy. It didn't work. It wasn't enough. They had to do something else. If they lowered interest rates, and you and I weren't spending all our money, we weren't borrowing money from the bank, they had to do something else. So they started forward guidance to tell us, if you think interest rates are low now, you should expect them to stay low next year, and the year after, and the year after, and maybe even the year after that. The idea is to scare investors out of cash and into the stock market. And they're also telling us in no uncertain terms, they're telling us very clearly, for the next few years, you will make no money in cash. There's this old saying in the United States, don't fight the Fed. This is now true in Europe as well. Do not fight the European Central Bank. Too much cash is a bad thing, okay? Number 8. It's kind of funny. Everybody loves to travel. Can you raise your hand if you like to travel? Okay. I just got back from a holiday in the Maldives. Beautiful islands, absolutely beautiful. I love to travel. My mom and dad also like to travel, okay? But what's funny is about human beings, as much as we love to travel and see the world, when it comes to investments, we don't want our money to go anywhere. We want our money to stay at home. It's a mistake. It's wrong. This page is in the Guide to the Markets that we publish in Asia. And on the top, you can see how investors are allocated across the different regions. In the United States, 27% of all investor assets are in cash or deposits. 27. In Europe, that number is double. At least it's not as bad as Asia, where it's as high as 77. But there's another problem. It's not just that the money's in cash. It's also, where is the money? And one thing that you can see at the bottom, and Americans are really bad. Most Americans have never been to Italy. Most Americans probably couldn't even point out Italy on a map. It's really bad. Look at this. 75% of American assets are right at home in North America. That has to change. In Europe, it's not as bad, but it's still a problem. 61%. And in Asia, over 80%. This home bias is a risk. Our clients need to be more diversified. They need to seek out opportunities overseas. And again, this is something that you know and that I know. But again, our goal is to provide you an unbiased picture that you can use when you have that conversation. Does that make sense? Okay. Lesson number 7. This one's a little more complicated. But I believe that valuation is very, very important. If our clients understood that the time to invest is when asset prices are low, they'll do better in the long run. And the other message about valuation is, valuation takes time in order to work out. Here's what I mean. This is page 14 from the US version of the Guide to the Markets, but we're happy to send it to you if you want it here. We might actually put it in the Europe Guide to the Markets as well. We'll talk about it after, Paolo, okay? Okay. On the left-hand side of this page, this axis here shows stock market returns in the next 12 months. And those returns are calculated based on the starting point of these valuations right here. If you invested at a low valuation where the stock market was cheap, generally speaking, your returns were a little bit better. If you invested at a high valuation and the stock market was expensive, the number was bad. But the results are kind of mixed. You can see they're all over the place because the time horizon is only 1 year. My message today is that our clients need to think longer term. And longer term does not need to be 10 years or 20 years. It could be 5. Remember, most of our clients used to invest for up to 6 years. Now their investment is only 11 months on average. This chart on the right shows the relationship over 5 years. It's much more tight. It's very, very clear that if you buy cheap stocks and you have the patience to wait just 5 years, you're going to win in the long run. So I hope that you find that useful. Now we're getting to some of my favorites. This is number 6. Rebalancing your portfolio is important. Again, you know this. As the promotore, you know this. But it's hard to explain to a client. The way I like to do it is if the stock market goes down 50% and the bond market goes up 10%, your portfolio allocation goes like this. It's not because you made a decision to change it. The market changed it. We must not allow our clients to let the market dictate their allocation. We have to dictate their allocation. And that's why it's important to rebalance the portfolio. This chart quantifies the importance of rebalancing over time. I know these two lines look very close together, but that's because it's such a long-term chart. If you look over here at the end, over 25 years, the difference between a basic portfolio that was reallocated and a portfolio that was not reallocated is a difference of 110% cumulative total return. Just by simple rebalancing, like an institutional investor, we can help our clients boost their long-term results significantly. Of course, diversification is important too. This is probably the most important lesson for all investors. But I want to give you a different explanation for why. You've all seen charts like this before. Every firm has them. This is page 64 in the Europe Guide to the Markets. But to me, the reason that we diversify is not for when the markets are going up. We diversify for when the market goes down. I'll give you an example. And I know this is a simple one, but for some of my colleagues from J.P.Morgan, they like to keep it simple. Let's say you had 4 chickens, okay? You had 4 chickens and 2 of them flew away, okay? I now have 2 chickens left and I've lost 50% of my chickens. If I needed to get back to 4, what return would my portfolio of chickens need to be to get back? 100%. I lost 50. I need 100% return. I need to double to get back. The message is clear. In order to succeed in the long run, you have to avoid losing money when the markets are going down. This chart clearly demonstrates the value that you bring to your clients when you offer them a diversified portfolio. In 2008, the global financial crisis struck almost without warning. The stock market was down between 40 and 50%, depending on the currency, depending on the market. But a very basic, balanced portfolio with stocks and bonds lost only half that much. So instead of losing 2 chickens, you only lost 1, and you have a much easier recovery to go. Again, this is all stuff that we all know. But our hope and our plan in designing this is to prove it to the public. They need the education. Remember, our clients forget these things, and maybe the most important lesson is one that we can borrow from Warren Buffett. It's all about emotion. Have any of you seen the movie Titanic? Remember that movie? I actually don't like that movie. But did you cry? Anybody? Come on, guys, men, you cried. I know it. I did. I cried because I wanted to turn it off. But anyway. Emotions are great for movies. Emotions are great for romance. Emotions must be out of investing. Here's why, by the way. This chart is computed by a company based in the United States, where they looked at all the mutual fund flow money, all the money going into stocks and out of stocks, all the money going in and out of fixed income, and so on. And over 20 years, they found that the annualized return for real estate was 11% per year. For gold, it was about 8%. Here's the stock market, the S&P 500, about 8%. Even fixed income, 6%. We're going down and lower and lower. Housing, 2.7%. Inflation, 2.5%. And then there's the public. The average investor, now this is America. The average investor in America, based on when they put money in the market and when they took the money out, achieved an annual return over 20 years of 2.3%. Why? A lot of it has to do with this. This is one of my favorite pages in the Guide to the Markets. I promise you, if you use this with a client, a light will go off. This chart on the left-hand side shows during the technology bubble in the United States, from 1999 to 2000, almost $850 billion went into equity funds. Everybody wanted to get rich by buying technology stocks. Emotions were running wild. Everybody thought they could get rich just by a stock. By the way, the blue bar right here, that's bonds. People ignored bonds. Why would you need bonds? The market only goes up. It's a new world, right? We all know how that ended with the stock market falling 50%. NASDAQ went down 80%. This period right here was defined by greed, exuberance. Alan Greenspan called it irrational exuberance, euphoria, all things that are good for movies and relationships, but not investing. Now fast forward to today. The right-hand side shows that since the financial crisis, this is amazing, 1.2 trillion, that's trillion with a T, $1.2 trillion went into bond funds. Equities were mostly ignored. What was the stock market return in the United States during these 3 years? 110%. In Europe, about 85, okay? This period of time was defined by a different emotion. This time, fear. When our clients come into new money, they get 50,000 euros because they sold a car or they got a bonus at work. If their portfolio is half equity, half fixed income, that's how we allocate it. Our clients need to understand that their emotions are going to try and force them to buy stocks when they're greedy and to buy bonds when they're afraid. In both instances, it's the wrong idea. And one final chart on this point. This is page 71 in the Guide to the Markets. This squiggly line, this line goes up and down, is a picture of consumer confidence in Europe. It's how we feel about the world. Of course, when it's very, very low, that's when there's probably a recession. It's probably when home prices are down, unemployment is up, maybe petrol prices are high, I don't know. But what we did on this page was to show in orange down here what the stock market return in Europe was in the next 12 months after these really, really bad periods for sentiment. In other words, if your only investment strategy over the last 30 years was to invest your money when you felt really fearful, your return in the next 12 months was 19% up 19%, up 30%, up 33%, up 44%, up 18% most recently. If instead you only invested when you felt good, now this is what people want to do. They feel good because everything's going well. I got a new job. My home price is high. The stock market's doing well. I feel comfortable investing my money. Then your average return from all of these periods at the top was negative 3%. Now, what this means to me is we have to keep emotion out. We have to keep logic in. Can anybody in the room think of a place in the world right now where sentiment is really, really bad, where the markets are low, where unemployment is going up? Where in the world is that right now? Europe's okay. I mean, Europe's getting a little bit better. Where in the world today is the real fear? I would say the emerging markets. It's hard to see how they will get better. It's hard to see what the catalyst for change will be. But they're cheap, and we're afraid. This is why it's so important, I think, to talk to clients about emotion. I've got 3 more. Ready? Here's number 3. I just want to make a point. Do not ever let your clients think that the global economy is not growing ever again. Don't. If you bet against the global economy, big mistake. This is a picture. This is not in the guide. I made this for you. This is a picture of world GDP going back to 1900. So this is 114 years of GDP growth. Look at this. Right up in a straight line. Now, all these blue bars that go up and down, do you know what those are? Those are the recessions. Those are the recessions, and you've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 recessions. In fact, the most recent recession, the global financial crisis, the credit crunch, the European sovereign debt crisis, there it is. Did that stop the global economy from growing? No way. If your clients are 65 years old today, and they have 15 or 20 years to live, and if our clients are fearful in putting their money in cash, and our clients have too much of their assets at home, and our clients are not buying cheap stocks, and they're not rebalancing, they're missing the opportunity. We think that now is an incredible time to invest. And I have just 2 more I want to show you. One, the power of dividends and compounding interest is very powerful. I'll only spend 1 minute on this. But this bar right here at the top breaks down the total return in the stock market over the last 75 years into 2 components. The first is how much of the return came from stocks going up in price. That's in green. The gray part shows how much of the return from stocks came from dividends. Over 75 years. And here you can see decade by decade. Here's the 1960s, 1970s, 1980s. Over 75 years, almost half of the return from our investment in stocks comes from dividends. And just on the bottom, if you only invested in the European stock market index, you just watched the price of the index, since 1999, you've actually lost money. But that's not what your clients, and that's not what I get when I invest. You get more than the index price. You get the index price plus dividends. And if you keep it in the account, they compound and grow. This chart, this line right here, shows the total return, including dividends and compounding. Same time period, but the return is 50% higher. And finally, if over those same period of time, you invested in higher dividend yielding stocks, your return was almost double your money. So dividends and compounding are critical. And finally, I just want to mention, nobody likes volatility. Nobody. But it's normal. When you get on an airplane, well, some people like the bumps. I do not. But we have to accept that the bumps are normal. If you never went on a plane because you're afraid of the bumps, you will never go anywhere. That's the same with investing. And what I try to show clients, and I'm going to see if I could switch to this picture very quick, is this page. This is page 50 from the Guide to the Markets. And what we show here in the green dots is what we call the maximum drawdown every single year. In 2010, all at the same time, from the period of April to July, the stock market fell 17%. From the 23rd of April to the 5th of July, 17%. One of the reasons was because of the big oil spill in the Gulf of Mexico. Remember the oil spill with BP? One of the reasons was that quantitative easing number 2 ended. And another one of the reasons was, do you remember the flash crash in America where the stock market fell 1,000 points in 1 second because of a computer glitch? Okay? That scared the market. It fell 17%, all in just a couple of months. If you look at 2010 right here and see that little green dot, that is the 17%. Now, by the end of the year, the markets had recovered. And you can see from the gray bar above it, for the full year, the market returned 11. That's pretty good. And what this chart shows, in fact, is that the average decline in a given year is 12%. At the end of last year, one of my favorite reporters, I won't tell you where she works, but one of my favorite reporters asked me, the stock market had an amazing year. It was up 25%. Do you think we're due for a correction? I said, yes. I think we're going to have a correction. And reporters love that, okay? A strategist from J.P.Morgan calling for a correction. Then she asked me, how much do you think the correction will be? I said, I don't know, 12.1%, okay? 12.9%, whatever. I gave her a specific number. She couldn't believe it. How can you be so specific? And what I did, I think I ruined it, but I showed her this chart. If you look back at every single year in history and take the average correction, it's 12.9%. I don't know what the future will hold. And that's what I tell my clients. I don't know if we'll have volatility tomorrow. And I don't know how much it will be. But in terms of what you should expect the markets to be volatile. Expect a correction every year. But also, 75% of the time, the gray bars go up because the market goes higher anyway. Volatility is normal. We have to accept that. And then one final chart that I just want to show you before I conclude this portion. This is one of my favorite pages. It's page 73. Paula, maybe if there was one chart, I think people should write this down, page 73. This chart explains to our clients why investing in the markets and market volatility is not the risk, okay? The biggest risk is living too long. The biggest risk is not having an advisor to help you. The biggest risk is not rebalancing. Volatility, that's not the problem. This chart will prove that to your clients. On the left, every time you see blue, this color, that is equity. Every time you see orange, that's bonds. Gray is 50% stocks, 50% bonds. It's easy. And this data goes all the way back to 1950. So this is 63 years worth of information. Now remember, we're talking about clients that are probably around retirement age, that have 20 or 30 years to live, okay? So back to this. This chart is as old as our clients. And what this chart shows right here You can see at the bottom it says 1 year. This number right here shows the very best 12-month return that your clients could have found in the stock market since they were born. 61% is a pretty good year. Here's the worst. Over 63 years, the worst return was 12-month period where the stock market fell 43. Does anybody remember what year that was? I'll give you a clue. It's really recent. 2008 and 2009, there was a 12-month period where the market fell 43%. Anything can happen in 1 year. This range is almost 100%. Anything can happen in 1 year. We have to convince our clients to think a little bit more long-term. How about 5 years? Keep in mind, if I think about the most recent 5-year periods, the first one is 2013, 12, 11, 10, and 9. The next 5-year period was 2012, 11, 10, 9, and 8. So these 5-year periods include the worst year in our client's lifetime, and yet, and this is amazing, if you just look at the investment returns over a 5-year period, in a portfolio that was half stocks and half bonds, what was the absolute worst return you can ever find over any 5-year period, even if it includes 2008, since they were born? -1. If the markets have the worst year in your client's life, they're going to be scared. They're going to want to put their money in cash. They might stop trusting me or you. But they have to know that if they have the patience to wait 5 years, that pain will go away. Time and diversification are on our side. And that's what we hope that the Guide to the Markets can do for your clients. I think I have about 5 or 10 minutes left. And in the remaining time, I just promised that I'd share with you a little bit about our view on the markets and the economy. And I'll summarize this at the end. But as you can see, I'm passionate about educating investors about why investing for the long term makes sense. But they also want to know what's happening today. And so briefly, I want to talk about why very easy monetary policy is both a challenge for investors, but also an opportunity. I also want to talk a little bit about the recovery in Europe, which I'm optimistic about. And then finally, I'll talk a little bit about what we're seeing in emerging markets and the United States. This is only 5 slides. It's not that painful, and I'll do it very quickly. Here are the 4 major central banks in the world: the European Central Bank, the Federal Reserve, the Bank of England, and the Bank of Japan. And here's a statistic for you. 86% of all the world's investable assets are in countries where the central bank policy rate is less than 1%. That is shocking. When my grandmother was taught her entire life to become more conservative as she got older, reduce her risk, and put her money in fixed income and put her money in savings, and now this happens. This represents a dramatic income problem. And the other problem is, what happens when interest rates eventually rise? I don't think it's going to happen too soon. But I eventually think that interest rates will go up. And one thing that I want our clients to understand is that that can hurt. So this chart right here, which is page 59 from the Guide to the Markets, shows if you own 5 or 10-year government bonds and interest rates go up only 1%, your bonds can fall as much as 5 or 10% in value. A lot of our clients don't remember that. Maybe 2008 and 9 taught them. But they have to understand that conservative government bonds are not the only answer. And today, Italian, Spanish bond yields are as low as we've ever seen. One thing that we talk to clients about is moving out on the risk spectrum. Here, for example, is high yield bonds. If interest rates go up 1%, they might not necessarily lose money. They could still have a positive return. One other chart, and this is very important to me. This is page 43 in the Guide to the Markets, and it talks about equities and rising interest rates. Some of our clients tell us that their biggest fear is about the stock market because in the past, they remember rising interest rates being bad for the economy. What this chart shows, and it looks confusing at first, but it's not that bad. First of all, everything in gray, everything in gray is the US stock market, and green is Europe. And all these dots show the correlation of equity prices to interest rates. So what I do with clients is I take this book and I actually cover up the bottom. So I go like this, cover up the bottom. Everything above that 0 line, everything above this line right here means that if interest rates went up, what happened to stock prices? They went up. That's good. That's what we want. Everything below this line means that if interest rates went up, stock prices went down. That's bad. We don't want that. So what we've done is show history, and what you'll find is that all the good outcomes are clustered to the left-hand side of the page. What is so special about the left-hand side of the page? Well, that's simply where interest rates in the economy were very low. In other words, historically, if interest rates are very, very low, and then they start to rise, the stock market loves that. Why? Well, think about it. The only way that interest rates can get very, very, very low in the first place is if the economy is very, very weak. The central bank lowers interest rates. All of our clients want to buy bonds and the rates fall. That's how they get low. From there, how do interest rates get higher? Well, the economy has to improve. That's good for stocks. So one message from J.P.Morgan today is that while rising interest rates might hurt fixed income when it happens, we think there's a long time to go before they start to hurt equities. Usually not until 5% do you have to worry. Last few slides. This just shows Europe getting better. On the top left, you can see industrial production and the manufacturing getting better. And importantly, on the top right-hand side, that's making people feel a little bit better. Maybe they'll go out and spend their money. But another really important dynamic, with the exception of Italy, actually, is that forecasts by the IMF, by J.P.Morgan, by BlackRock, Goldman Sachs, and so on, are for less austerity, less fiscal drag across most of the developed world. This will help economic growth find some solid footing. I think that I think in Italy there's still some challenges, okay? But Italy will benefit from the improving conditions around them as well. Italy exports some of the highest quality manufactured goods in the world. And so that's one thing that I would point out there. Last two, I promise, final two. Emerging markets are where most of the concern is today. As a personal, in my personal portfolio, I am buying emerging markets. I don't care if it works in 2014. I don't care if it works in 2015 or 2016. I have a long way to go. Okay? Right now, they're cheap. You have to brace for some volatility, but the key message for investors in emerging markets is that you can't paint all of emerging markets in one brushstroke. They're different. In this chart, which is page, I don't even have the page number. It's in the guide to the markets, trust me, okay? I use 3 paintbrushes, red, orange, and green. And this is very simple. This line at the bottom simply shows the size of a country's current account deficit. How much money do they need to borrow from the rest of the world? And then this axis shows how much, it's the other way around, but this one shows how much their currency has weakened. And the idea is, these countries in red have had the worst trouble. These countries in orange have done okay. And these countries in green haven't been hurt as much. The whole idea is, when you invest in anything, equities, emerging markets, fixed income, the reason that our clients hire you is to help them identify asset managers and portfolios that can identify the problem countries from the opportunities. It's about differentiation. And I think that that's going to play out in emerging markets. And finally, the US, I'm actually very bullish on the United States still. That top left-hand chart shows the total household wealth. How much assets do households have in America? Today, households in America have more wealth than ever before. This chart just below it shows their debt having fallen dramatically. And on the right, home prices, housing activity are all getting better. So the US stock market is high. But I think an improving economy, less fiscal drag, and very easy monetary policy will continue to help the US stock market go up. So overall, we see opportunity. And finally, I just want to thank you very much for having me here. If I could just summarize, I think we all agree that our clients need to think about their long-term future. The trouble is, as human beings, we're not created that way. We're created to think about right now. We worry about volatility because it's happening today. We watch TV to see what's going on in the world right now. But 5 years ago, in the midst of the financial crisis, nobody was thinking that over the next 5 years, the stock market would double, or that all those losses we suffered would be gone. Our hope is that in partnering with all of you and in using some of these tools that J.P.Morgan and some of our very, very strong competitors provide, you can help your clients keep an eye on the long term and achieve their financial goals. So we'll see you over at the J.P.Morgan booth. Hopefully we have some cocktails and you can play with the app. And thank you very much.